So as I was saying, the for those who will be watching this at home, I will have those the first drafts of the ethics assignments, ethics assignment number 2, graded by tomorrow with a little bit of feedback. Again, just like the first one, don't kill yourself on this assignment. You know, just you're writing up a memo, you write up an email, and you send that, you know, that you would send to your boss. And so I'll do my best to give meaningful feedback. And you know, and mostly I wouldn't spend hours and hours and hours on it. I think you've got a final exam coming up, and I'd rather you spend your time on that. So if your rough draft was decent and all, you'll probably get feedback that says just submit this as your final and you're good. And I shouldn't say decent at all. If there's some like glaring thing, even if it's really decent, but there was like one issue, I would still let you know that. But I would say it's not as important as some of the other things we have going on, I think. And that's feedback I try to provide to the course designers too. Like, yeah, it's great, but like there's so much other content in this course. We don't really need additional assignments, is how I feel. But yeah, well, I guess they do ask. I say no one asked me, but they did ask me, and so I told them. Anyway, so any other questions before I kind of move into a little bit on the chapter 9 stuff? All right, so let me get there. So as you know, you're knee deep in it already, but let's see. Chapter 9 is about notes. And well, there you go. So just one of the things that's kind of tricky about this work is, like, in real life, you never have to wonder if like you're the one, if if it's a note receivable or a note payable. Whereas when you have it in a book setting, you have to like decide, oh wait, am I the company that's lending the money, or am I the company that's borrowing the money? In real life, you know that absolutely. You know, oh, I'm borrowing money or I'm lending money. So I think, again, there's a lot of things in accounting that are actually harder when you're doing it as a student, reading it from a book, because you have to get all these context clues from the word problem, rather than just in real life, I lent money out. So there's just a couple of scenarios, unless you're British, then there's a couple of scenarios that we want to just look at. So the first is it's not that unusual when someone owes us money on a short term, that they'll say, hey, I can't pay you. Can we write a long-term note so that I can pay you off spread out over the next year or whatever? So the first is this example. The Brady company is asking McGraw to accept a $100 cash and a 60-day, so 2-month, 12%, $500 note to replace its existing $600 accounts payable. This is actually pretty normal. Okay, people they just can't always afford to pay it. And so in my business, where I work with, where I have a storage, I tend to want to reward people who are making an effort, right? So if they can't pay me today, but they're willing to pay me over the next 2 months, and I get to make 12% interest, I'll do that for sure. So all we do when that happens is, in essence, think about our accounts payable as a liability, so it would have a credit balance on it. So we're just going to debit that accounts payable account, and that'll take the accounts payable down to 0. And then, oh, I'm sorry, I'm getting confused if I'm the payer or the borrower or the lender. So we're actually, yeah, so we're the borrower, right? And we're trying to pay this off. So I think I read it as if we were the other way around. So we're borrowing money here. We can't pay it. And so we're going to debit our accounts payable to get rid of that account payable. And then we'll credit our notes payable and credit our cash. So the accounts payable is going down by 600, getting rid of it. And then our cash is going to go down by 100, and the notes payable is going to go up or increase by 500. I think that's a pretty straightforward one. It's almost like it takes you back to journal entries all over again, though, and you're like, oh, like I have to think about that. Hopefully, you never forgot, right? You've been working on journal entries all along. Then when we go ahead and pay it off, we're going to not only pay the amount we owed, the $500, but we're going to pay the interest expense. Again, the principle of, or the formula, principal times rate times time is going to come into play. So we take the principal, or the amount owed, times the rate, and then time is always expressed as a fraction of a year. This course loves the 360-day year convention, which is really slowly fading out of normal convention. We typically in the real world use a 365-day convention, just because we're using computers and it's not hard for computers to do that. Back when everything was done by hand, it made sense to just kind of consider a year to be 12 months of 30 days each, and kind of not worry about the other 5 days. But so in these problems, again, you'll have to kind of look, and it'll usually tell you use the 360 days. In real life, you'd have to look at the policies of your company. Whether if it was your own personal company, you'd set the policy. If you were working for someone else. So again, the principal or amount owed times the rate times the time comes out to $10 or $10. And so there's our journal entry to pay it off. We pay $510, 500 of which was the note, and $10 of which was an interest expense.
Brother Fox.
Yeah.
This probably doesn't matter in the context of the course, but in a scenario like this, who would usually dictate like that interest rate? Like, would it be the person coming and saying, I can't pay this, but I'd be interested in doing like this at a 12%? Or would it be the company being like, I'll accept that with a 12% interest? Like, who would normally set those terms?
Right. If you think about it, the lender, they kind of have all the power in this situation, because the borrower already borrowed, right? And so now they're trying to renegotiate the terms of their borrowing, and so the lender has all the power. So they'll typically dictate that amount. Although, I mean, it can be done. Many companies just have a policy saying this is how much we charge. I mean, but it can be negotiated. People do all the time. I carry the note
But
when
converting accounts payable to notes payable is a pretty standard type of practice.
Okay, well, so I said that it was pretty standard, but by pretty standard, I mean it happens.
It happens.
But it doesn't happen, you know. I can
Okay.
think of in 15 years of business, maybe 2 or 3 times we've done it. So it's and so we can't even just say the prevailing market rate, I guess, because that fluctuates. But honestly,
Would just be we'd rather you pay us, so we'll go with these rates.
yeah. Well, and the other thing is here's a person who's already defaulted on their first promise, right? And so they probably are going to have to pay well above market interest rate because they're a risk. You know, the same reason if I go borrow money right now, I'll get, you know, a 1 rate, and my 18-year-old son will get another rate because of the amount of risk that he poses relative to me.
Okay.
So yeah, it's still dictated by the lender. I mean, they're still going to say, I'm not doing this for less than 10% or 12% or whatever.
Okay.
And I'll just say it's really dangerous. We own a building on the boulevard, and so there's a restaurant out front. And when they default on the first month, then how are they really going to make it up in the next month? If business is hard right now and we let them default, and we have 2 former tenants now that both owe us thousands of dollars because we were kind and said, okay, we'll let you go this month, and then next month it's the same problem, and then the next month, and finally after 6 months we're like, we're not doing you a favor and letting you stay here. We would do you more of a favor to kick you out and let you out of the lease and release the property to someone else than to let you stay. So it's a double-edged sword.
Yeah, usually I like to have a sense. Well, what's nice about being in storage rental is I still have their property as collateral, right? Whereas a lease is a little tougher, a building lease or something like that, you know. That for whatever reason, I think the storage associations had a really solid lobby, and in most states, you know, we have that possessory lien like built into state law, and so you know, whereas it's harder to say you're leasing an apartment to somebody, you don't have a possessory lien on their property that's inside the apartment in the same way. Anyway, we're getting way off track. Not way off. it's actually the interesting part because it's real life instead of stuff out of a book. Anyway, so when we borrow from a bank, same idea, right? If we're the borrower, then our cash goes up and our notes payable go up. I think the most common error, it's not an error, I think I guess it's an error that people make, is they're always trying to figure out, because the problem will always tell you like the amount that's borrowed, the interest rate, and the amount of time. And so in that first journal entry, they're trying to figure out where they're supposed to put the amount of time and the interest rate. And there's nothing. The initial entry is always just the cash increasing, and then the liability note payable also increasing. And then when we repay it, it really is as simple as just the cash decreases by the total amount of the note payable and the interest expense. And then of course we have to calculate the interest expense, but that same principal times rate times time formula. It does get a little dicier when a note extends over 2 financial or accounting periods, right? Like I say, if it extends over the end of the year, because when that happens, we have to do an adjusting entry to recognize the interest expense that has accrued and has been incurred to date. We have to recognize that at the end of the year, a certain amount of the interest expense we're going to have on this whole note, even if it's not due, even if we don't have to pay it, because a lot of these short-term notes, you really don't, you just pay it, the principal and interest all at the end, as opposed to notes where we do like why did I just draw a blank on the term? Where we build the payments and the interest into the payment schedule. So just recognize that when a note extends over 2 periods, we're going to have to do an adjusting entry at the end of the first period to record any interest accrued to that point. So here's an example. The company borrows $2,000 from the bank, 12% interest for 60 days on December 16th. So on December 31st, we'll go ahead and do an interest expense debit and an interest payable credit, just to show that interest expense that has incurred during the year. That lets our books be correct, right? So that we show the correct amount of expense on our end of year income statement. And then when the note comes due, we're going to pay off not only the note payable, but also that interest payable that we created during our adjusting entry, and then any interest expense from January 1st to the date of payment. This one, remember back when we learned about adjusting entries and I said like this never goes away. I say creeps up. So this is an area where people sometimes are like, whoa, I forgot all about adjusting entries, even though you had them. If you think about it, they've been peeking through in a lot of these chapters, but here they are again. And anyway, and so I think if you're in the boat, and some people are, where you never really understood what adjusting entries were, you just figured them out good enough to get through the exam, or not even, you just sort of said, oh, I'll miss those ones on the exam. This can still be a hang up for a lot of people. So just recognize that adjusting entries are always about when we have an expense that we have incurred, but we haven't yet paid for, or when we have revenue that we've earned but haven't yet received, or vice versa, when we've paid an expense but haven't yet incurred it, or when we have revenue that we've received money for but haven't yet actually earned. We have to recognize at the end of the accounting period any expenses incurred or revenues earned, so that our balance statement, and I'm sorry, that our income statement will be correct. That's really all there is. But it really can be confusing when there's a lot going on.
And so, wait, can I just ask a question on that slide?
Mm-hmm, mm-hmm.
So the type is really little on my screen, but I think that the whole amount of the interest was $40, and you took 10 of it in the year previous, and then 30 after the January 1 deadline.
Mm-hmm.
So we don't add that $10 to it, because now we're taking it out of interest payable, right?
Right.
So the tax number is 2040. Yes.
Right. Yeah. So yeah, exactly. So $10 of interest was recognized in the previous period as an expense, and $30 from the current period, or however, whatever terms you want to use, from 2020 and 2021 in this case. All right. So now we're down to payroll, everybody's favorite thing to do. I once taught a person how to use QuickBooks Payroll because she was doing payroll by hand, including withholding taxes by hand for 75 employees on a weekly pay. And I showed her QuickBooks Payroll, and she named her next child after me. That's how much people love doing payroll. I don't know that she named it after me. I choose to believe she did. I mean, it had the same name as me. And it has to be because, I don't know if anybody's ever done payroll withholding by manually, where you're like, there's a little table and you have to be like, okay, this many exemptions and this is the amount, and then you find like this little rate and then you calculate it by hand. Terrible. Anyway, so I mean, anybody who's ever received a paycheck, it's one of my favorite. There's always like memes, or not memes, but like little TikToks of like kids getting their first paycheck because they'd already calculated in their brain how many hours they worked times their pay, and then it's way less, and their siblings are laughing at them, like, welcome to life. Anyway, so we know that the net pay, that our gross pay, the amount, which is our hourly wage times the number of hours worked, or our salary, is going to have a whole bunch of stuff deducted out of it before we get to our net pay, the amount we actually get to take home. And so they give you a formula, which is net pay equals gross pay minus deductions. Thank you, McGraw Hill. We couldn't have jumped to that on our own. Anyway, so common deductions will be our taxes, federal and state. Some places are lucky enough to have local income tax. We do not have that in Arizona, and I'm grateful for that. They don't have that in Utah either. Texas doesn't even have state income tax. And so you're like, ooh, maybe I should move to Texas. But their sales tax is higher because they got to get it somehow. Other voluntary deductions, where I work, you can pay into our college's foundation for scholarships for students or whatever. And then we have FICA taxes, FICA, which is Medicare and Social Security. So that's what the employees have to pay. A little green arrow just to I guess even more highlight the fact that they gave us a formula. Thanks, guys. All right. So FICA, Social Security and Medicare, this is 2019 numbers, but which I think is what we're using for this book. 6.2% of the first $132,900 a person earns in a year will be deducted from their as Social Security taxes, and another 1.45%. What's crazy about this is the employer also has to pay a matching amount, which most of you probably already know, which really stinks when you're self-employed, right? Because now you pay your half as the employee and the employer's half, and suddenly you're paying like 15% of any money you earn. My wife is she's an artist, and so she often has to deal with this, and she doesn't really love it. I don't know why. Anyway, so the employer withholds that money from your paycheck and then pays it to the IRS. Federal income tax is also withheld and paid to the IRS, and then state and local income taxes are paid to whatever the taxing authorities are within the state, which is kind of obvious. I don't know, I should include all these slides, but again, employee voluntary deductions could be insurance, could be pension contributions, could be charitable donations, all those sorts of things. So recognize that when an employer withholds money from your paycheck, that those become payables to them. They become liabilities to the employer. I think that's something that's easy it's not obvious until you've worked on that side of it. And then you're like, oh, I guess it does, because what they've done is they owe you the full $2,000 that you've earned. But then they're only going to pay you $1,524. The rest of it were withholdings. And those are liabilities that have to be paid to these various entries or entities.
Because those are actually being paid on our behalf. Those aren't being
Correct.
paid, those aren't being paid by the company. Those are ours,
Right.
right? Like
We
that's
earned-
why.
Right. We
Okay.
earned $2,000. they held out, in this case, $476 total, which is our money, but
Mhm.
they're paying it on our behalf.
Okay.
I mean, I guess in theory, right, it would make the employer's job a lot less complex if it was like, we give you the full amount you earn and it's your job to pay all of these things. It also make the IRS's life a lot, worse, because they would be having to receive these payments and try to enforce this from everybody. I think I'm all about making the IRS's life less comfortable. They're so bogged down right now, though. I mean, we're seeing government failure in action with the fact that they're struggling to just manage. I had an error on one of my returns for my business, and I swear it took them it was like the next year's was coming up when they finally sent me this thing saying you have an error, and then they charged me a penalty for each month. And it was like, if I'd known within a month, I would have corrected it, but instead, so I had to go through this whole process of kind of fighting them on that and getting them to reduce it. So I'm all about making their life difficult. All right, in legal ways. Anyway, so then the journal entry when we actually pay the employee is just going to be the salaries payable is going to go away. So we're going to debit the liability salaries payable, and we're going to credit cash. And then we would do one more, we would do one more journal entry where we would debit each of these accounts, right? And pay cash as we send. But what the employer does is they send all of those in one big check, and it's not even a check anymore, it's electronic. But I guess I don't know if there's businesses still trying to do like those payroll withholdings with paper checks. I doubt the IRS will even take them anymore. They probably want you to. So in addition to what the employee has to pay and the employer has to withhold, there are also employer payroll taxes, money amounts that the employer has to pay over and above what the employee pays. And so I mentioned before that Social Security and Medicare taxes, those are paid half by the employee and half by the employer. And then the federal and state unemployment taxes are also paid by the employer. And so, when you hear of somebody going on unemployment because they lost their job and they're drawing unemployment benefits, that's where that comes from. Okay, is that unemployment tax is supposed to create a fund. We hope that the government actually leaves it in a fund. Probably they spend everything we give them, and then we're drawing against money that's not there. But that's a talk for another day. All right. So that's what I mentioned. So federal employment tax, 6% on the first $7,000 of wages paid to each employee. And then state unemployment tax, which is usually 0.6%. And then, I'm sorry, and then 5.4% on the state unemployment tax. And again, so these are limited, right? 6% of $7,000 is
that on a yearly, like 7%, the first 7,000 in the year?
uh-huh.
And is that always like, is that a calendar year, or does that depend on the company's fiscal year?
It's a calendar year, as far as I know. I'm pretty sure. This is not something I do for a living, and
Okay.
so, but to my knowledge, I believe I could double check it. I don't work payroll side. I probably should, because everybody hates it so bad. There's probably a good market for, if you can find a good person to handle your payroll. It's interesting, at the little college I work at, we have a bookkeeping certificate where someone can, it's just, whatever it is, 15 credits, and it's kind of teaching QuickBooks and some basic accounting and some basic office management skills. And I'm surprised at the number of students who go out there and just start up shop with that, 1 year's worth of college and have a pretty success, especially young moms who are just not wanting a full-time thing, but they'll just do the books for 3 or 4 businesses, and they're making a nice side income. So there's a market. People don't want to deal with it. The best markets are markets where people don't want to deal with it. That's why morticians have such a solid market. None of us want to deal with that. All right. So employer payroll taxes. So you'll see that instead of when we did the withholding and we recorded those as as payables, but on the debit side was just the total amount of salary and wages that the person earned. Here, what we're doing is we just debit them as a payroll expense directly. And then all the different amounts there. Let's see. All right, so that's kind of the end of payroll. And then one last concept. So we sometimes have estimated liabilities. In other words, like we know we're probably going to have to pay some money, but we don't know how much yet. These come up with things like warranties, right? If we offer a warranty on our product, we may have to pay out on that. Lawsuits, if someone's suing us, we may have to pay out on that. So this is their definition. It's a good definition. It's a known obligation of an uncertain amount that can be reasonably estimated. Okay. So there's some examples, like I mentioned. Yeah. So here's an example. We have an employer agrees to pay an amount for medical insurance equal to $8,000 and contribute an additional 10% of an employee's 120,000. Let's see. Oh, sorry, I skipped to the next one. So health and pension benefits. I was just defining for you the last one, and then one other concept, health and pension benefits. So again, we just debit that usually as an employee benefit expense. And then again, they're payables because they're being paid to third parties like an insurance company. So the idea is that employer is not required by law to provide insurance to its employees, right? And even if they have an insurance program, they don't have to pay for it. They can say this is available to you to pay for. But some employers do. I know mine pays for my health insurance, but then also makes available for me to pay for my dependents if they want. And so they do both. They pay for part, but then make the rest available. So whenever an employer does that, again, they debit the expense and then credit whatever payables they're going to pay to those third parties. So vacation benefits, same idea. I don't know what else, not much more to say about that. Same with bonuses. You debit the bonus expense and then credit bonus payable. And then when you actually pay the bonus, then you debit the bonus payable and credit cash, right? So warranty, this is a good definition. I teach a business law class, and we go way deeper into it, of course. But the idea is, as a seller, we make certain we warrant that our product is going to work the way it's supposed to work, in essence, and we promise to make it right if it doesn't. And so, but that makes it really hard to know how much of that we're actually going to have to pay. In essence, what we have to do is kind of make an estimate, especially our first few years of operations, as to how much we think that's going to be. And then after a few years, you start to get a sense of it, right? You can kind of look and say, well, last year, this many people actually filed warranty claims and we had to pay out this much. And so, that's all we can do. So in the problem, it's going to tell you what their past experience indicates. So it'll say past experience indicates warranty expenses average 4% of the car's selling price. So again, they go ahead and they debit the warranty expense based on that 4% of the selling price, and then credit a special account called an estimated warranty liability. It's not really special, it's a liability account, but it's special in the sense that it's estimated. We don't know if we're going to pay all that. Then whenever we actually have someone make a liability claim, we'll debit the estimated warranty liability and credit. In this case, it was the parts inventory. So they gave the parts to the person. It could be cash if you paid it out in cash. Anyway, so then at the end of the year, you end up with some kind of a balance in that account, right? Because you're crediting it whenever you make the sale and debiting it whenever it's actually used. And then that balance, you can kind of adjust over years. You say, okay, well, we're not having 4%, we're having a 3%. So that balance in the account allows you to have a sense of that. And then contingent liabilities so contingent just means definitionally like based upon another event, right? If we say something is contingent.
Brother Fox,
Yeah.
sorry, to jump back really quick to the warranties.
Uh-huh.
So like with past things, we've had like when they would estimate like receivables and uncollectible receivables, it was like either they would base it on sales or they would base it on like a percentage of what was in, you know, so they have all these different methods.
Mhm.
And so with this, in this question, they based it on 4% of that specific sale.
Mhm.
Or would it always be a percentage of every individual sale, or would it just be a percentage of like, would it vary?
Yeah.
Like,
So
you see what
no,
I'm
I think it's a great question. So so in real life, there's more than one way to estimate warranty
Okay.
liability. Okay.
Okay.
For the course, I think just for simplicity's sake, they're just doing it as a percentage of sales.
Sales. Okay.
But it's pretty common to like just do a single adjusting entry at the end of the period to say this was the total amount of warrantable or warranted sales made during the year. And so we're going to take 4% of that rather than on each sale, just because it would become pretty burdensome if every
Mhm.
time you made a sale to have to do that.
Okay.
Now, maybe a car dealership that's only selling 100 cars a month or something like that. Maybe it's just part of their standard journal entry when they do it. But yeah, though it's actually a pretty astute question, because if you think about the previous example you mentioned where we're doing accounts on receivables, if we use a percentage of sales method, we don't worry so much about the balance in the account, right? In the doubtful accounts account. But
Mhm.
but if we do a balance-based method or a balance sheet-based method saying a certain percentage of what's owed to us,
Right.
or then we worry about bringing it up to the balance up to a certain amount. So don't worry about that for this
Okay.
chapter. They're just
So
going to
just
do
a
it
percentage of
of
sales.
sales.
Okay.
Yep,
Perfect.
that's a great question. So a contingent liability, again, is a liability based on something else. Okay. The most common contingent liability would be like a lawsuit. Okay, where some money's owed to, where you may have to pay out. And so I like that they give us a crystal ball here, like, because we're just supposed to guess the future. And here's the kind of the rules. If we have a future event that is remote, then GAAP, generally accepted accounting principles, in essence dictate that we don't have to make any disclosure about that. We don't have to tell our shareholders or tell the public about this at all. When something shifts from remote to possible, and usually that's based on our attorneys honestly coming to us and saying, before we thought there was a remote chance we'd have to pay out on this, now it's looking like we possibly might have to. And so if something's possible, then we're going to disclose it in our notes to our financial statements. So we're not going to actually change our balance sheet or at all. We're just going to put in the note, hey, we're currently facing litigation. There's a possible chance we'll have to pay. But usually at possible, you don't know how much. Then the lawyers can kind of upgrade it to probable, saying it's likely we're going to have to pay out on this. And then probable is broken into two different types. One is what's called estimable, meaning it's probable we're going to have to pay and we can estimate about how much it's going to be. If that's the case, we go ahead and record that as a liability, as an estimated contingent liability on our actual books. It'll show up on our balance sheet. And if it's non-estimable, then we just disclose it in our notes. Again, it would say something like, our counsel advises us that this contingent liability that we'll probably have to pay, but at this time we can't estimate the amount that we'll have to pay, something like that. And that's it. So there we go. Any questions, other questions about that? Or I do have one student who emailed and said they had another class to be at tonight, but asked me to look at question number 6 on the quiz access if we had time. But people who are here take precedence. Sorry, no offense. But if you had a question, I would do yours first and then do that one if time permits. Anyway. All right, well, while you're thinking about it, I'll go ahead and start bringing up the quiz access real quick. Let's see. McGraw Hill. All right. Let's see. Am I sharing my screen? Usually there's like a little green box that comes up around it, but I'm not seeing that right now. All right. So it says use the following information for the exercises below. BMX company has 1 employee. Well, that's easy. FICA, Social Security, 6.2%. Yada, yada, yada. Okay. Let's see. So it says compute BMX's amounts for each of these 4 taxes as applied to the employee's gross earnings for September under each of the 3 separate situations. So let's see. In situation 1, the employee had earned $5,800 through August 31st, and their gross pay for September was $1,400. So I think what they're trying to get us to do is say, well, how much would their FICA, how much of it would be subject to tax? So remember, FICA is on the first $132,900. So for the vast majority of employees, it's on everything they make, right? Like it's not that many people in the world that make $132,900 a year, especially as individuals, maybe households that make it. But even then, if you make 132,000, you're still in the top 10% of wage earners in the US. And that includes people like Jeff Bezos. So really, you're making good money, all right? So their entire $1,400 pay for September is going to be subject to the tax. So we're going to put 1,400, and the tax rate is 6.2%. And then to calculate the tax amount, we just take the amount times the rate, gives us the amount. Medicare, same thing. The whole 1,400 is subject to the tax rate. We take the tax rate it gives us, 1.45%. And so then we just calculate it out. Federal unemployment, this one, remember, is only on the first $7,000. So if they've earned 5,800 already, then their whole 1,400 would put them over that $7,000 threshold. So it's only going to be $1,200 worth because that's the amount that will add up to the 7,000. So 1,200 is subject to the tax. The amount of the tax it tells us is 0.6% or 0.6%, $7.20. And the state unemployment, same thing, only the first 7,000. So it'll be $1,200 times the rate. In the second, so then in the second scenario, they've only earned $2,300 this year. So in that case, you know, all of the 2,400, and they're earning 2,400 this month. So all of that 2,400 is going to be subject to FICA, the Social Security, and the Medicare. And because this doesn't add up to $7,000 yet, then all of it, this 2,400, is also going to be subject to the federal unemployment and the state unemployment taxes. So the entire 2,400 multiplied by the rates gives us the tax amount. In the third scenario, they've already earned 127,900 this year by August 31st. Good for them. And so then the question is, well, how much of that will be, so how much of the 9,300 they're getting in September will be subject to those taxes? And so again, we would just say, well, the first 132,900 that we have to pay FICA on. So if we've already earned, we only are going to have another $5,000 that we can apply those taxes to. So it's going to be the first 5,000. The Medicare taxes are 1.545% of gross pay. So we're going to pay on the full amount. Okay. And then since the federal unemployment and state unemployment are only on the first 7,000, we've already passed that threshold. So there won't be any tax applied for those. So once you know, I actually like the way they break this down. Once you know the amount that's subject to tax, then it's pretty easy to just take the tax rate and multiply it out. So I know that wasn't any of your question, but maybe it was valuable to you, or maybe you've already done it. There we go. So whoever, I forget, I think it was Laura who asked me to do that. So Laura, when you watch it later, that one's for you. Other questions? Are we done for the night? Christy's trying to find the unmute. There it is.
No, I had a few questions about that one, but because I was working through it, but I hadn't finished. But now that I watched you do it, I realized what I was doing wrong. I was just adding incorrectly. Instead of taking the amount that was still taxable, I was taking the amount over. Does that make sense? It was just a dumb little mistake. So yeah.
There's nothing like accounting to help you make dumb little mistakes where you're
Well-
like, and then you start questioning, like, do I not understand the principle? And you're like, it's not that you don't understand the principle, it's just there's a lot of little moving parts.
Well, I was kind of laughing at myself because that's what I do for work. I do payroll.
Okay.
But I don't have to calculate this. QuickBooks does it for me. So I was
Yeah.
like, I should know how to do this. But anyway.
If any of you have never used QuickBooks Payroll, in the setup, you just put in someone's hourly wage and then you just punch in the number of hours and it does everything else for you.
Yeah.
Or if they have a salary, you just, it remembers that salary and then you would only have to add if there were, some
Yeah.
special pays. It's pretty wonderful.
Oh, it's beautiful.
The business I was talking about before, they had gone through this massive growth. And so it was a construction business and his wife took care of the books and they had 7 employees that were all family. And so they did weekly payroll and then they exploded into 75 employees in about a 4-month period. And she was still trying to do it all by hand. And for weekly payroll, it was taking her like 3 days. And she was still,
Yeah.
again, looking them all up on the table, makes you go cross-eyed after a while. So
Yeah.
QuickBooks, but then people are like, but they charge me like 100 and whatever a month for their service. And you're like, pay it, man. Totally worth it.
Yeah.
All
Yes,
right.
it is.
Any other questions, comments, curses, whatever you want to?
Are you going to be doing still a meeting next week
Would you
to
like me to
review
do a meeting next week?
anything for the exam? I just didn't know if there was anything to review for the exam.
Yeah, I mean, so,
If it's beneficial, if you've done it in the past, I just didn't know how it works. Because there's not really anything as far as like quizzes. I mean, everything else is due this week. So
right. Yeah, about as much as I could do, and I'm willing to do it if it's valuable. I don't know, I think on one of our exams this time around, I just sort of walked through that document, the exam study document, and sort of talked through that and answered some questions. I can't do more than that. And I'm willing to do that next week if people want. But it would be kind of nightmarish if you consider the length of that entire document and the fact that the exam is comprehensive. Although I want to look at that document real quick and see. I want to see how they laid it out. I don't remember off the top of my head, so I want to look at it real fast. I'm just trying to remember if they were like, yeah, just look at all the rest of this, or if it's like, oh no, so it does break it down. So like if we go to exam 5, oh, that's too slow of scrolling. So if we look at exam 5, it's going to break down by chapter each of the things to really review. And so again, if next week, if there's people who want me to kind of just read through this and answer questions, I'd be glad to. I don't know how valuable that would be to me as a student. But I'm not much of an auditory learner, actually. Like I'm more like, give me a book and leave me alone. And so everybody's different. I will say, and I think a lot of people maybe missed this, but where is it at? I'm trying to get back to where I came from. I didn't think it was on a. Anyway, so all of those ungraded assignments, so people are like been freaking out because they have a due date like at the end of the course, and they're like, whoa, what is all this that I'm supposed to do? And so like recognize that they're part of a grading category that's worth 0% of the grade. So but the reason that the course designers made them so they were open all the way until the end of the course is so that people can use them in their review if they want to. And so I'm talking about all the what were those called? They're not called. They're like, I have to find it here. And I'll show you what I mean.
It's like the supplemental
Right.
study materials,
Right. That's
videos.
that's what the category is called, right? And then it's like, so in each one, they'll be like, okay, thanks. Okay. So there'll be like these. Do they even have them in those? Yeah, supplemental study materials. And so those are all these different things, supplementary concept videos. So those are just there for people to use them if they want them, but they're not like assignments you have to do, which I think from the nods I'm getting, most of you knew that, but I've had a few people, I think they just look on their, on their home screen where it shows what's due and it shows those things as coming up due. So what do you think? Do you want to have a meeting next week? One more?
I just was wondering if you were scheduling and planning on it.
Mhm.
If that wasn't in your plan, then you don't have to add that to your plan. But if you were gonna do it, I was gonna plan to be at it.
It's not in my plans. So and I saw Marta nod. So we will plan on having a meeting next Tuesday, last one. If this were a face-to-face class, I would bring donuts or something. Okay, but so instead I'll bring you virtual, I don't know, virtual deliciousness, whatever that is. But yeah, that sounds uncomfortable. I will stop there with that. Anyway, okay. Well, I'm about out of time. I have to get to class in 4 minutes. Thank you for taking the time to be here, and we will plan on being here next week. And I will actually post, here's what's going on this week. I just didn't this week. Plus side is got another kid married off. So, all right. So let's, anybody willing to offer that closing prayer? Marta already said one. She's got enough blessings.
I can do it.
All right, terrific.
Father in heaven, we're grateful to be able to be here tonight and to be able to learn and to be able to fill of each other's spirits. And we ask that you to please bless us as we finish out this semester, that we will be able to retain all the knowledge that we have gained and that we will be able to be successful. And please bless Brother Fox in his other endeavors as well. And we're so very grateful for all that we have. And we say these things in the name of Jesus Christ. Amen.
Amen. All right. Have a great night, everybody. I'll see you next week.
Good night.
Bye.
Bye-bye.
Thank you.